Welcome to video number 12, our final video in the preterm accounting tutorial video series and our final video in the accounting crash course. In this video, we're going to prepare the financial statements for our exercise company. Take a look at where we are on the roadmap. We're at our final video. We've done transaction analysis, journal entries, T accounts. Now we're going to prepare the financial statements. We're at the end. Remember our journal entries? Yeah, that was based on our transaction analysis, we recorded debits and credits. Within journal entries, we made sure our debits equaled our credits. Then we posted those journal entries to our T accounts. So where are we in the accounting process? Well, we understood and analyzed the transactions. We recorded general journal entries as the transactions occurred. We posted them to T accounts. We got to the period end. We recorded adjusting journal entries. We posted that to T accounts. Now we're on step 4. We're ready to report our income statement. Our income and expense accounts can be put on the income statement. So here they are. This is the income and expense accounts for our company. And what we can do is simply put them on our income statement. Okay, there's actually nothing that complicated about it. The $600 of revenue gets placed at the top of the income statement, $200 of cost of goods sold, $100 of wage expense, $100 of depreciation expense for net income of $200. Okay, that's our income statement for our company. Okay, so we reported our income statement. Good for us. Now, step 5 is we need to now zero out those income statement accounts to get them ready for the next year. So we need to record our closing journal entry. That's when we transfer the income and expenses from the income statement accounts into retained earnings. So let's take a look at that. Again, here's our T accounts for our income statement accounts, and now I put our equity accounts in there as well. Retained earnings has a balance of 0, but that's not accurate, is it? We've got some earnings now over the life of our company. So we need to reflect that fact using the closing entry. The first step of the closing entry is to zero out all of our income statement accounts. You can see revenue is holding a credit of $600. To zero that out, I debit revenue, $600. Cost of goods sold is holding a debit of $200. Well, to zero it out, I credit cost of goods sold by $200. I credit wages expense by $100, and I credit depreciation expense by $100. And when let me just post this part of the journal entry. Okay, I've posted that part of the journal entry. We're not done with the journal entry yet, but I posted that part of it. And you can see that after posting it, the balances of my income statement accounts are now 0. Okay, I've zeroed out my income statement accounts and I'm ready for another year, but my balance sheet doesn't balance yet. The reason is this journal entry doesn't balance yet. You see, I've got a $600 debit and I've only got $400 worth of credits. Remember the rule of journal entries, debits equal credits. So as long as debits equal credits, that's going to make our balance sheet balance. So what we're missing is a credit of $200. That's the plug to balance this journal entry. So that credit goes to retained earnings. That's the rule in the closing entry. You balance the journal entry to retained earnings. So we'll credit retained earnings by $200. Now watch the retained earnings account and watch how I post this $200, credit to retained earnings. It goes right on the credit side of the retained earnings account. And now retained earnings is holding a balance of $200. And that's equal to our life-to-date net income. That's our accumulated net income minus accumulated dividends, right? We've got accumulated life-to-date net income of $200, which is just this year, and we haven't paid any dividends. So retained earnings is sitting at $200. Okay, let's put a check mark next to record the closing entry because we did that. And now that we've done that step, we are ready to report our balance sheet. So back to our T accounts. These is our asset, liability, and equity T accounts. And all we do is we take the ending balances of each of these accounts and we just place them in their respective spot on the balance sheet. So assets go up in the asset section. Liabilities can go in the liability section. There's only one non-zero liability this year. It's debt at the end of the year. It's debt. And then the equity section, we've got some contributed capital and our retained earnings. And so as you can see, our balance sheet balances, assets equals liabilities plus equity. And we've finished accounting for this example company for the year. Now we've gone through the entire accounting process. We've understood and analyzed transactions. We've recorded general journal entries as the transactions occurred. We've recorded adjusting journal entries. We've posted all those to T accounts. We reported our income statement. We did our closing entry. We reported our balance sheet. Now we can present our income statement and our balance sheet. If we're Rivian, we present our income statement and our balance sheet to investors, and investors decide whether they want to take a risk on our loss-making company, whether they want to invest in our company or not. Prospective employees can use our balance sheet and income statement to learn more about our company or our industry, and managers within the company can use the income statement and balance sheet to make good business decisions. Well, thanks for watching this pre-term accounting tutorial for the MBA. This video series has been exciting to do, and I hope it was useful. My name is Henry Lorien.